Good morning. It's Wednesday, the 2nd of April, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming from Mumbai, India's financial capital. The Take. It is useful to note that while President Donald Trump's pronouncements on tariffs may have sounded wild, arbitrary, and inconsistent in recent months, the 2025 National Trade Estimate report published by the U.S. Trade Representative on foreign trade barriers is anything but that. The Just Out report lays out in exhaustive detail the United States' concerns on a wide range of areas and covering both tariff and non-tariff barriers. In some way, the NTE report is a useful looking glass through which to see concerns of key trading partners and areas India can actually work upon in the context of that oft-used term, ease of doing business. For instance, the report stated that the United States has placed India on the priority watch list due to inconsistent progress on intellectual property concerns. It highlighted the lack of specific laws for trade secret protection as a significant issue, along with long waiting periods for patent grants. Fixing these would arguably help Indian companies and patent seekers as well, at least to some extent. The report also highlights items from data localization norms, that's in the digital space, to India's regulations on import of milk, pork, and fish products. These imports require genetically modified free certificates without providing a scientific or risk-based justification, the report says. Former government officials had told me earlier that India could not and maybe would not budge on genetically modified crops, like in the case of soya bean, because in doing so, it would kick off a firestorm amongst farmers within India. And that would be only one of many firestorms the government would have to grapple with were it to allow any duty cuts on agriculture or dairy products. Bottom line, it's extremely unlikely there will be tariff reductions here. The report also points out that India's average applied most favored nation tariff rate is about 17% overall, but rises to an average of 39% on agricultural products. Now, there is a Dhobi list of issues well compiled and documented and going back several years. For instance, India's price caps on essential medical devices such as coronary stents and knee implants, affecting what it says are US manufacturers' profits and products availability. Interestingly, pricing of imported stents is an issue that Prime Minister Modi raised in an election rally in Uttar Pradesh in 2017, which is the local elections there. Yes, it goes that far back. The government had reduced prices of cardiac stents by up to 400% and capped the prices of them here. Obviously, this is something that patients in India, particularly in the poorer sections, would have welcomed. While all of this would have figured prominently in the trade discussions in recent weeks, where it could finally land is not clear at the moment, particularly since India was called out once again on its high agriculture tariffs by a US government spokesperson just the day before. Now, tariffs are forcing new alignments. A Reuters report out yesterday quotes China saying China, South Korea, and Japan will respond jointly to the US tariffs. South Korea has already called the statement somewhat misleading, while Japan has denied a statement, though admitted to the talks. The fact that such a three-way partnership is even being discussed conceptually is quite astounding. India has actually two partners, in a manner of speaking. One is the public sector of government, the other is the private sector of business. R. Subramanian, Managing Director of DHL Express in India, which handles a large part of India's logistics and trade movements, told me on the core report that he was impressed by the innate confidence of Indian business that they could manage things, meaning tariffs and their impact. And then there is the government, which has been working furiously, including via visits by the Prime Minister and Trade Minister to Washington, D.C., and multiple other ongoing official meets. And several steps to bring down or remove tariffs and duties ranging from motorbikes and whiskey to an equalization levy on digital advertising called Google Tax at 6%, which is gone. Now, the US is obviously asking for much more, as is quite evident, and the gap between what is being sought and will be offered might be large. It might take effort to bridge this gap and possibly a steep price to be paid as well. The good news is that India has made encouraging strides in responding to an external crisis of the likes we've not seen in a long time. Hopefully, this one lesson will stay with us as we go past April 2nd into the next tariff crisis. And that brings us to the top stories and themes. The stock markets reel from impending tariff impact on both imports and exports. Gold hits another fresh record high. India's residential real estate deals slow down, but commercial is on sound footing. Will tariff wars accelerate de-dollarisation? And airline cargo and passenger airline growth figures slow in February after a while.
This is a core report with Govindraj Ethiraj.
Markets brace for tariff impact. Markets don't like uncertainty. While we know that, this is a good point to remind ourselves that the markets are turning jittery once again ahead of tariffs and their likely impact, largely because we don't know where the tariffs will precisely land, but will do so in a day. And fresh threats of tariffs, including secondary tariffs on Russian oil exports, which could technically affect India, thanks to which oil prices are staying high, just under $75 a barrel at around $74.60 a barrel. Remember that markets were looking up in previous weeks because oil prices were easing off, among other factors. Now, back on Dalal Street, stocks did take a sharp dive in the first trading session of the new financial year. The Sensex closed down 1,390 points at 76,024, and the Nifty 50 was down 353 points to 23,165. Amongst the broader indices, the mid-cap and small-cap indices were down by about 0.9% or just under 1%. The IT sector was amongst the hardest hit due to its exposure to the US economy, and real estate stocks fell following the state of Maharashtra's upward revision of ready reckoner rates, which affects property valuations according to the Business Standard. Gold prices extended their record run on Tuesday, with spot gold at about $3,133 during the day, after hitting an all-time high of $3,148 per ounce on Tuesday. Meanwhile, Bank of America analysts were also projecting gold prices at about $3,500 an ounce in the next 18 months, up 13% from the current levels, given all the reasons that you already know. What they did point out was that central banks currently hold about 10% of the reserves in gold, and this could go to 30% to make their portfolios more efficient. Bank of America said that retail investors have been increasing their exposure to gold, as we know, with assets under management at physically backed exchange-traded funds increasing about 4% year to date in the Americas, Europe, and Asia. Indirect taxes up, consolidation gains. India's gross goods and services tax collection for the month of March rose about 10% to 196,000 crore rupees, or about $23 billion, according to figures released by the Finance Ministry of India on Tuesday. Net GST, excluding refunds, rose about 7.3% to 177,000 crore rupees, or 1.77 trillion rupees, compared to 1.63 trillion rupees collected a month ago. Elsewhere, the consolidation of ownership or assets continues across India Inc., and this one involves the government too, which gained more ownership of once privately, or rather fully privately owned telecom company Vodafone. Its stock price rose about 20% on Tuesday after India said it would convert a part of the firm's outstanding spectrum auction dues to equity, which of course gave it a lifeline. The government's stake in Vodafone Idea will increase to about 49% from about 23%. after it converts about $4.3 billion of dues to equity. Elsewhere, the Kolkata headquartered ITC said on Monday it would acquire the pulp and paper business of Aditya Birla Real Estate for about 3,500 crore rupees, or about $410 million. The acquisition would add about 480,000 tons per year of capacity to ITC's paperboards and specialty papers business. It said it already faces headwinds from low-priced Chinese and Indonesian supplies in global markets, weak domestic demand, and an unprecedented surge in wood prices, according to Reuters. It is, of course, interesting that Aditya Birla Group was holding on to the paper business, an area that it does not or did not seem to have much interest in, at least from a growth and expansion point of view. China extends an arm. China is willing to buy more Indian products to balance trade, Beijing's Ambassador Chu Fei-hong said just ahead of the US tariff announcements that would come on Wednesday, that's today, later in the day, India time. We are willing to work with the Indian side to strengthen practical cooperation in trade and other areas and to import more Indian products that are well suited to the Chinese market, the ambassador to India was quoted as saying by China's state-run Global Times and reported by Bloomberg. Bilateral trade between India and China stands at about $102 billion as of last year, with India running a significant deficit. India's exports include iron ore, marine products, petroleum, vegetable oil, adding up to about $20 billion, and the rest is imports. A lot of it is electronics. The ambassador's remarks were to mark the 75th anniversary of diplomatic ties, and Chinese President Xi Jinping also called for stronger communication and cooperation between India and China. He said that it was the right choice for the two nations to be partners and that he was willing to deepen coordination in major international matters and jointly safeguard peace in the border areas, according to Bloomberg. Xi Jinping and Prime Minister Modi met on the sidelines of a BRICS summit last year and had not had a formal bilateral meeting prior to that since 2019. Among other things, there was an agreement to restart direct flights between India and China. Earlier, China also said it was seeking to coordinate its response on US tariffs with Japan and South Korea, according to Chinese state media. Japanese and Korean officials said that there was no decision to coordinate action, but they said that they discussed trade issues amidst three-way talks over the weekend, the first such dialogue in 5 years, according to the Wall Street Journal. A social media account run by China's state broadcaster said the three countries will strengthen dialogue on supply chain cooperation and export controls and plan to conduct speedy negotiations towards a trilateral free trade agreement. According to that post, again quoted by the Wall Street Journal, Japan and South Korea are hoping to import some semiconductor raw materials from China, while China is also interested in importing chip products from Japan and South Korea. A South Korean Trade Ministry spokeswoman told the Wall Street Journal there were some exaggerated aspects in the Chinese social media post, while Japan's trade minister said at a news conference yesterday the three countries exchanged opinions on the trade environment, but they did not reach any agreement on joint action against US tariffs. Nevertheless, the fact that these three countries have conferred in this manner is notable. Residential real estate slows down, commercial stays strong. Rising residential prices have slowed down the Indian housing market's bull run in the first quarter of 2025. Latest data from real estate consulting from ANAROCK shows the year's first quarter saw sales dropping about 28%. Now, this is across the top 7 cities against the same period in 2024. Mumbai Metropolitan Region, or MMR as it's called, and Pune accounted for about 51% of total sales, with Mumbai seeing a 26% annual drop and Pune a 30% annual drop. Interestingly, Hyderabad saw a 49% annual drop, which was the highest, and Bangalore the lowest drop at about 16%. Meanwhile, in one of the largest commercial office space rental deals in Pune, City Corp has leased about 770,000 square feet of office space in a deal that spans about 10 years and is estimated at about 1,096 crore rupees. And elsewhere, in residential, Godrej Properties has revealed that they sold 275 homes for more than 2,000 crore rupees in its new housing project called Godrej Riverine in Noida in Uttar Pradesh, which is spread over 6.5 acres. Now, back to commercial space. The big news is the sheer demand for commercial space, thanks also to global capability centers who are expanding furiously in India. The figure is 80 million square feet, and more on that. I reached out to Anuj Puri, chairman of ANAROCK Consulting, and I began by asking him how he was seeing the real estate market right now, both commercial and residential, and more importantly, his outlook for the months ahead.
It is true is that since COVID, start, we've seen this cycle really strengthen up. From the beginning of 2020, nearly coming up to 5 years, we've seen pretty decent increase, both in terms of the supply for residential and in terms of the absorption, the sale for residential. As a consequence of this, the unsold inventory has come down to a record low. So the cycle over the last 5 years has been very decent. What we have seen, having said that, in January to March 2025 quarter, if you were to compare it to January to March 2024 quarter, that the number of units that were sold were 28% lower than last year. And you have an interesting question is that data on one side, what is some of the color? Why, the sales have started to slow down? How does it look like? And, hopefully as we progress with our discussion, what is the outlook going to be for this sector? So, Govind, I think 3-4 things. One, Q1 2024 was the highest ever sale that India had witnessed in any quarter. So, to beat that would have been a very tough job for this quarter to deliver it. So, clearly, we were coming in from a very high base. That's one. Second is, Govind, somewhere the sort of nervousness that we've seen in the last few weeks in the stock market, although it seems to have arrested now, that is getting reflected in the mood for the luxury and the ultra luxury housing sales. Because majority of the people who are consolidating their positions in the stock market, using that money to buy residential, and overall sentiment that comes along if the stock market really goes down. And third is some global uncertainties, what's happening, with the tariffs and just on the global outlook, as a result of which many of the home buyers are not canceling their purchase or delaying it. as a result of which, this quarter, we've seen the sales getting pushed out. I'm hoping that much of it will be caught up in the next quarter. But as far as this quarter is concerned, it got pushed out. And lastly, I do feel is that as the inflation starts to come under control, and you are a lot more expert on the economics and the inflation part, is that I do feel is that home loan rates will start to come down, which are high at this stage. And hopefully that'll then kickstart the demand once again. I do want to say sort of one very quickly brief thing on the offices. Going just, out of the park, the ball has been hit on the demand. We're just seeing a ton of GCCs, the global capability centers, coming in to India. And calendar year 2024 was the best ever since independence. Nearly 80 million square feet of gross demand. And why I bring this up in our session is because ultimately that also reflects that there is a huge amount of job creation happening in the top 7 or 8 metro cities where the GCCs are located. So hopefully nothing fundamentally wrong. It is just that we're coming from a very high base of last year, first quarter, and that's why this blip that we've seen.
What could be the median growth then, if assuming we are adjusting now, like we adjusted in GDP, most projections are 6.5% or thereabouts, not let's say 8 or 9%, which we had seen in the previous year. How is the real estate sector looking like in terms of growth in the next year or two?
So, Govinda, I divided into two parts. One is on the price rise, because a lot of the viewers would want to know that how do we expect the price rise over the next year or two. And second is the volume sales. So on the price rise, I do believe is what we've seen in the past, we may not witness that price rise. It'll be more in line with the inflation rate. So, perhaps 5 to 7% increase in the price rise over the next year or two that you're going to see within the residential real estate. As far as the volumes are concerned, I do believe is that 2024-25 as a financial year would be really where the base should be compared to. And above that will be about a 6 to 8% increase in the volumes that you will see. I do also want to say one other thing, Govind, is that this current financial year, 24-25, supply was dwarfed, given the various challenges that we had, for example, Maharashtra election. So we lost 3-4 months in the approval process. Similarly, earlier during the financial year, central elections were there. As a result of it, the approvals got delayed. And that means that if the new supply gets delayed and does not get the approval, and that's where majority of the sales really happen at the time of the launch, as a result of which, those launches sort of got delayed and hence impacted the overall volume, both on the supply and the demand side. So I'm hoping much of it we'll be able to catch in FY 25-26. So as a result of it, we'll still see a growth of 6 to 8% over FY 24-25 in terms of the number of units sold.
Just to come back to office space, you talked about 80 million square feet of gross demand, which means that this is the space that is there and has been rented or leased. Is that right? Or is it created?
No, this is the space that is there and has been leased.
Which means more that's been constructed?
So it's about the same that is being constructed. So the demand and supply situation on the office side, particularly in cities like Pune, Bangalore, Mumbai, have been very good. The only city that I would call out, Govind, for your listeners, viewers, is Hyderabad. I do feel is that there is an oversupply situation both on the residential side and on the commercial side. Nothing wrong in the demand in that city. It's just that there is oversupply situation in many of the micro markets within that city that is being created, as a result of which you can see in that city there will be some softening of the rentals for the office market and likewise for the residential.
And sticking to office, since you brought it up, we saw a very big deal just a couple of weeks ago with Citibank signing 1,000 crore deal over, of course, more than a decade. Of course, one is the size of the deal and the other is the length of the commitment. So are you seeing a lot of big deals like that on the horizon? Even in terms of conversations that are going on?
Absolutely, good. And it is not only IT or ITS or the banking financial services. These are consulting companies. These are manufacturing companies doing their R&D. A lot of them are insurance companies who are setting their global capability centers. What is heartening to note is that India has sort of moved away from just IT or ITES services to say is that, we're now becoming the knowledge process outsourcing for the world. We're becoming the R&D center for the world. That excites me, Govind, because it's no more a cost arbitrage game that they're coming into India. They're coming for talent in the quantities that they need. And those quantities are not available elsewhere. The STEM graduates that are coming out from India are far larger in numbers than what are coming out from the US. Now, admittedly, China does have even larger number of students on the engineering side than in India coming out every year. But India has an advantage because it's an English-speaking nation, as a result of which many of the American companies are able to associate with us a lot better.
You're saying that there are big deals still in the pipeline in terms of conversations that are going on, which could result in big real estate lease transactions, which could obviously and will lead to jobs, which is obviously good for the economy. Okay, so let me come back to a slightly different point. You've put out a lot of research in the latest report, as you do every month. What are the other data points that you feel you would need as someone who is focused on this sector to, let's say, strengthen the quality of your observations or your outlook?
3 or 4 things. One is, one, the job creation. How's the job creation really going on? Because ultimately, residential is dependent on how the job creation is happening. If there is, better quality jobs, more homes get sold. Second is the GDP data that I would look at it, because that shows the strength of the economy and the ability for the home buyer to be able to go out and pay. Third, I would say, is the stock market. Again, stock market is more sentimental other than in the luxury and ultra luxury, where it is actually, impacting, given that many people consolidate from the stock market and invest in those. But otherwise, or the mid level, it is more sentimentally that, we keep a track of it, is that if it is stock market does have a large variation towards the negative side, then we see similar sentiment on the resi sales as well. And the last one I would say is really on the interest rates, because that does have a huge impact on the home loans. Majority of the people do take home loans, and the EMIs are a big influence on the homemaking decision for them.
Would you suggest people in the mid range or the higher range, where most transactions are happening in any case, to hold on or go ahead as they would in 2025?
So if they are investors, Govind, or if they are speculators, I would say definitely hold on, because you're not going to be able to see the price rise that you may be expecting on the residential side. But if you are end user, then I would say of a good quality, develop a good quality product in the location that you want. I would say don't hold back. As an end user, please go ahead. These are great products, great companies, great location. You are able to get in the choice of the apartment that you want at an early stage. And hence, as an end user, I would encourage. But as an investor, I would say is, stay back.
And if I can supplement that, you're also telling people that early stage is fine. I mean, when you look at least the roster of builders, their track record so far in delivering and so on.
I'm encouraged by Real Estate Regulation Act, RERA. Since the time that it has come, it has a lot of teeth, Govind, and the way that it has been structured is beautiful. There is an escrow account. As a home buyer, your money goes into escrow, and that money is largely used towards construction of the project where you bought it. So as a result of it, I'm sort of encouraged to say to the people is that at the early stage, you're going to get a better price. And given that there is RERA, it is a lot more secure than what it was when there wasn't RERA. And hence your ability to be able to get your house, given that the installments are going towards construction of your project, is a lot more secure than earlier.
Right. Anuj, pleasure speaking with you as always. Thank you so much for your time.
Thank you, Govind.
Will the rupee's rise hold for now and beyond? The rupee will erase nearly all the gains it has made against the US dollar in the last 2 months and fall towards an historic low over the next 12 months, according to a Reuters poll of 36 foreign exchange analysts. The rupee has gained about 3% in the last 2 months, ending a 5-month losing streak and also marking its largest monthly gain since November 2018, thanks, of course, to that reversal in foreign capital flows and a weaker dollar. Analysts in that poll, however, told Reuters that the rupee would be held down by slowing economic growth and expectations that the dollar will not weaken much further in coming months, and more on that shortly. The rupee was forecast to drop about 2% to 87 rupees 18 paise per dollar in 3 months and then trade at about 87 rupees 50 paise in 6 months and finally decline to about 87 rupees 80 paise by the end of March 2026. Speaking of the dollar, veteran foreign exchange analyst Jamal Mecklai of Mecklai Financial has argued that the weak dollar will accelerate de-dollarization. De-dollarization is a natural process of stabilization as the dollar's presence in world markets, in forex transactions almost 89%, trade invoicing about 50%, SWIFT payments 42%, international debt securities 42%, cross-border loans about 32%, far exceeds the US economy share of both global GDP, which is less than 25%, and international trade, which is about 12%. The share of the dollar in global central bank foreign currency assets has been falling, actually, is down to about 59% from about 70% in 2001, and it was 85% in 1977, that is. There are several reasons for this, but the important thing is that it is falling. I reached out to Jamal Mecklai and I began by asking him how he was seeing the pace of de-dollarization right now and where the Indian rupee stood in all this.
Like everybody, I have been terrorized, I would say, by Trump. Thinking about it, reading about it, etc., etc. What I think is the good news and also terrible news at the same time is the fact that these guys do not know anything about the market. They do not know that the market is stronger than everybody, right? So they are going full speed ahead. We can talk later. I read an article about something called the Dark Enlightenment. And there are these, sort of philosophers who are talking about democracy is dead. The Chinese model is actually the winner, where people have no rights, but you can build the economy, right? And it really seems like Trump is going in the direction, he doesn't give a shit about people's rights, right? He's saying, I'm going to do this, I'm going to make America the greatest thing in the world. Now, the fundamental difference between China and the US, and there's many great things that China has been doing from what I read, but the fundamental difference is that China has not allowed the market in, whereas the US is as open as you can get. So my concern is that at some point, maybe in the next 6 months or the next 2 years, there's going to be a major, major collapse in the US, right? Simply because these guys, they don't think about the market. Normally, in the old days, Trump would be proud about the equity market going up. It's really collapsing and, hey, no matter. We got to do this, we got to do this, we got to do this, right? Seemingly unaware of the fact that all of the things he's talking about are actually negative for the economy and bad for his constituents, right? But I don't know if you do, but I look every now and again at Fox News. They are triumphant. Like, this is fantastic.
I think the argument there is that this is going to be short-term pain, but long-term gain.
Correct. But my point is the pain is going to be so severe, right? Because the market doesn't want to put up with this. The market is the market. It just takes everything and says, all right, bye, I'm going. This is my main concern about what is, happening. Now, the good news, and it doesn't really speak as to what is going to happen to the dollar, although my personal view is the dollar is going down. And this is a sort of a broader picture. The good news is, and India needs to think about how to make it good news, is China. They have been knocking it dead. DeepSeek came out and everyone said, my God, where did that come from? Again, I don't know this from personal experience, but I've read this article which talked about digital renminbi and the amount of the volume of transactions that are flowing through there. See, these guys are not letting up. You all know about the infrastructure there. I saw something on social media. People are able to pay with their palm. I mean, they are way ahead of, even on the UPI type thing. So to my mind, the saving grace in this whole game is China. Glad we're finally beginning to think of it. We need to actually build a serious relationship there. In any case, we need to. You got this big animal on the side, virtually your biggest trading partner, the biggest trading entity in the world. If you're not friends with them, you're a fool. So that's really where frankly, I'm thinking as I'm talking, because everyone is like, oh, we're in a new world, right? So in terms of what is going to happen to the dollar, right? It's clearly, as you've seen from those numbers, see, it's unbalanced, right? 25% of the world's economy and, 80%, 90%, 72% of everything else. It can't last forever. So there's a natural trend for it to be coming down. And Trump, of course, is making it worse because he's told everybody, I don't care who you are. So whatever flexibility anybody has to move away, they're going to move away. So my sense is this whole process is going to accelerate. I mean, you won't see it. It's not like the reserves are going to go from 59% to 29%, right? But I mean, there'll be slow and steady drip, 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 drip. So, and I think most important is that people are, you got a friend and he acts terribly. Oh God, what are you going to do? You start looking around, you find other people, you start working with them more, playing with them more, and then you forget about this guy. He's big and fat and dangerous and violent. And that is, of course, another.
So you've talked about this digital RMB cross-border settlement system, which will be connected to 10 ASEAN countries and 6 Middle Eastern countries. Thus, about 38% of world trade could bypass SWIFT and be settled in RMB. So is that something that's foreseeable? And we're also assuming that the US will not do anything, and all sort of links back to how strong will the dollar stay and for how long?
See, it's not really about dollar strength, right? I mean, see, we all think in terms of, reserves and this and that. Ultimately, trade is the play. Okay. And this whole thing with SWIFT, it's so inefficient. The banks get fat on it, right? Some years ago, I was in the US. He gave me a $10 bill and then he said, give it back to me. He said, you've been a bank. Basically, the float is where they make money, right? They do other things too, but the float is where they make money. Now, a SWIFT transaction takes 3 days. Even in India, our UPI, we've got a few experiments going with Singapore, Paris, etc., etc. This is all retail, and this is not really anti-dollar because since the currency rates are, even if it's in Paris, you want to go to the Eiffel Tower, you can pay with your GPay. But the fact is the rate goes through the dollar. India's thing is not threatening the dollar yet. China certainly thinks the hell with you. And apparently a lot of countries, I've got this somewhere, I read it, I have no independent verification, but a huge number of countries are buying into this. And you can imagine if there were 20 buying into it 5 years ago, there would be 120 now. Because everybody knows that you've got to build a second game, which may end up being the main game.
Right. Thank you so much for joining me. Airline cargo and passenger growth slows down. On both cargo and airline passenger growth, numbers are now beginning to taper off in what appears to be a sign of how things could be in the rest of the year. IATA figures say the total cargo demand measured in cargo ton kilometers declined about 0.1% compared to February 24 levels, which was plus 0.4% for international operations. This marks the first decline since mid-2023. The International Air Transport Association, or IATA, represents some 340 airlines, representing about 80% of global air traffic. It also pointed out that year-on-year comparisons are affected by the extra day in February 2024, thanks to that leap year. Meanwhile, total passenger demand measured in revenue passenger kilometers, or RPK, was up 2.6% compared to February 2024. International demand was up 5.6%, but in January, that growth number was 12.3%. Domestic demand fell 1.9% compared to February 24. Load factor was at about 82.6%. We need to keep a close eye on developments in North America, which saw falls in both domestic and international traffic, IATA's Director General Willie Walsh said. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.